what is tax loss harvesting? Well, this strategy, if used properly, can help you save thousands, perhaps even tens of thousands in taxes if you stay on top of your investments and use it proactively. But the idea behind it is actually quite simple. So here's how it works. Let's assume that you purchased fund X, Y, and Z in the beginning of the year for $1,000. The markets are down, and by the end of the year you have $900 in this fund. So if you decide to sell it, you would essentially realize a loss, or you would harvest a loss of $100 that can now be used to offset your other gains in your taxable accounts. So you would want to do that as frequently as possible, essentially across your entire portfolio. Now, let's say you have a year when you don't have any capital gains. In that year, you would be able to use up to $3,000 of your harvested losses against your regular ordinary income, and then the remaining losses, and this is very important, can be carried forward for an unlimited number of years. So they can really help you offset your capital gains in the future. Now, in practice, if you decide to sell fund X, Y, and Z, you would normally want to replace it with a similar fund so that your asset allocation remains mostly unchanged, but this fund needs to be similar but not identical to the fund you sold. And this is very important because if it's identical, then the IRS wash sale rules will kick in and the loss would be disallowed. In short, this strategy can be extremely beneficial, again, for those who stay on top of your portfolios, because it can help you save thousands, if not tens of thousands, in taxes in the long run.